The all-powerful Fed indirectly dictates investors' opportunity costs and hence the price of cloud computing software companies. Furthermore, in a recession, enterprises are prone to cutting back tech spends. And I think that this is the real crux of the anti-cloud stock sentiment right now. And it makes sense, right? In tough times or recession type environment, a lot of the CapEx could bleed dry from the market. So CapEx is the budget line in all corporations where they spend, particularly on the IT side, whether it's for new services, price increases, projects, etc. And there's a pretty strong sentiment that CapEx itself would go down in 2023. We'll take a look at that more closely here in a second. Now, this person, Hunting Alpha, says that his or her technical analysis framework based on trend flow, support resistance, and false breakout traps suggests incumbent downward flow in the WisdomTree Cloud Computing ETF, but no valid sell entry yet. So this is based on technical analysis or chart type analysis. A little bit different than what I do on this channel, which is rooted mostly in fundamentals, things such as earnings per share, P ratio, ratios of that kind. We're going to skip ahead in the interest of time and get down to the point. It is nice on Seeking Alpha because they break these articles up, but we're just going to go right down to the conclusion, right? So leading indicators, after he looks at all these charts and shares his point, leading indicators such as corporate earnings growth, overall spending trend, and an easing of rate hikes will be key triggers for WCLD to stop its bearish descent, consolidate, and outperform the overall market again. However, until these developments manifest, I am maintaining a hold rating on WCLD. And I think that that's a pretty fair sentence, right? Person is not necessarily bearish on cloud computing in the future, but in the short term, through technical analysis, they've come to the analysis that it's just not worth jumping in any new positions in WCLD. If you own it, hold it, is what they are saying. But if you're not in it, you may be able to wait for a better entry point. Now, let's take a look at that WisdomTree fund. Again, this is WCLD WisdomTree Cloud Computing ETF. If we go on the 5-year chart, you can see that this one peaked roughly November of 2021. It was at $64.29. Here we are today, under $25. And as a matter of fact, you're down minus 0.7% or so today. Now, I wasn't initially familiar with this ETF, so the most important thing in my cloud research is I wanted to see, what's in this WisdomTree Cloud Computing ETF, okay? So we're just going to look at the top positions they have here on Seeking Alpha, top 10 holdings, Yext, which is a location management software, if you will, for businesses. If you think about Walgreens or CVS with the bazillions of locations, it helps them integrate with Google Maps and stuff like that. That wouldn't really be the first thing I thought of when I thought of cloud computing, but here it is. That's what Yext is in there. Clearwater Analytics, Workiva, Avid Exchange, Copa Software, Smartsheet, Wix, which I know is a website development platform where you can make your own websites. Squarespace is fairly similar. PagerDuty, communications platform, cloud-based communications platform. Box, which is a basically cloud storage platform. And that rounds out the top 19% of this particular ETF. Now, at least in my opinion, when I look at that top 20%, those are not the names that, to me, I think of when I think of cloud computing. Now let's look at an ETF that I would say aligns better with, my assessment of what the top cloud companies are if I were trying to cram them all into an ETF, and that would be SKYY, First Trust Cloud Computing ETF. This one very similar in their losses. Okay, the names are different, the losses are the same. $119, $120 or so back in November 21, and here we are today at $57.59. But if we go to the holdings, scrolling down here, if we go down to the holdings, the top 10 holdings make up 36% of the fund: Mongo Database, Oracle, IBM, Microsoft, Pure Storage, Nutanix, Alphabet, Arista Networks, Amazon, and Lumen Technologies. For me, again, much more representative of what I would anticipate out of a cloud ETF. I would say that the WisdomTree one was maybe more like a cloud software ETF, and maybe that's the general purpose of it. But I did want to point that out since the first article was about the WisdomTree Cloud ETF. To me, analysis on that particular version or that particular ETF might have some misses in it when you're thinking about the cloud market as a whole, which is what I'm trying to do here today. And speaking of the cloud market as a whole, that brings us to our next article. So, slowing growth in cloud stocks. When will we hit the bottom? And this particular analysis is written by Beth Kindig. And while I do not know Beth personally, I can say that she has a well-respected newsletter, and I believe that she's made several appearances on some of the major market networks, CNBC, etc. And when Beth speaks, I'm typically all ears. I think she has pretty good insights across the industries that she covers. It is interesting to me that this comes out as a fairly negative sentiment in terms of the headline, because I would put Beth in there with the bulls, so to speak. I do not want to speak for her, but I would say generally speaking, she's bullish on the long-term future of technology. All right, so same deal on the summary. Nearly all cloud companies are reporting notable sequential slowdown between Q3 and Q4. The question is, at this rate of rapid decline, when will we hit a bottom? Across all categories of IT spending, Gartner, which is an industry research firm, is calling for a combined growth of 5% in IT budgets compared to 0.8% growth in last year. So that's kind of interesting, 5% growth this year, at least projected, compared to less than 1% last year. So very interesting news there. Big three cloud infrastructure as a service provider disagree with the survey results, the prediction that a rebound is coming. And so let's go through this. I am going to call out a couple of the charts that are on here. So you see we're getting to the Gartner surveys. Let's see if this thing will come up on the full screen. I believe it did. This is forecasted IT budgets 21, 22, and 23. So data center systems, that one looks like it reached a peak in 22, which of course was last year. And this is looking ahead at 3.4%. Software took a nosedive last year. Could be up this year, although not to the same highs. Devices, so hardware, sharp decline from the year before, and it is expected to go down at least a little bit more heading into next year. IT services, again, no surprise, the peak in 21 still had growth last year, and the 23 growth is expected to ramp back up a little bit. Then communication services went from a 3-year high down into negative growth and could make a bounce back up into this year if everything goes as Gartner expects. How about this one? Public cloud end user spending in 2023. Let's go through some of these acronyms real quick. This is business processes as a service, so hosting business processes. This could be things like accounting or user registration, stuff like that. Spending up last year 9%, could be up 8% this year. Then we have platform as a service, so hosting a platform on a third-party service, okay? This could be, I guess, in some ways similar to hosting an app on a cloud service, but think of a larger environment, a larger platform on the cloud. 23% growth last year, same projected for this year. Software as a service, 14%, and then potentially higher this year to 17%. And this is growth, okay? So this is incremental year over year. So if you're thinking about this platform as a service, it could have 2 sequential 23% growth years for that particular category. Management and security, 20% growth last year on spending, could go 22% this year. Next, we have infrastructure as a service. And this is kind of how I think about cloud and the potential growth for cloud. This is when you're taking all that hardware, those huge servers and database systems that typically reside in an off-site somewhere, using this type of cloud computing power, signing a contract to eliminate that from your life and just simply use Google's or Microsoft's. Incremental growth projected here, plus 27% last year, plus 30% this year. Next, you have desktop as a service. So when you think about the IT resources that are drained at a company just by issuing laptops and desktop type applications, you can actually have sort of virtual work desks now where you obviously still need a computer, but perhaps a Chromebook, for example, for just a few $100s. And as long as you can connect to the internet, then you can bring a full desktop that you would have seen, say, 5, 6, 7 years ago. You can bring that experience to your Chromebook right through the internet. And it looks like a slight downtick there, 23% growth last year, at least in spending, 22% this year. So still pretty strong in the 20s. And then total market combined, so last year was 19%, and then the projections, at least right now, are 21% incremental spending in these areas combined. So to me, that's a strong sign that money is still coming in to the cloud. How does it break out to the different usage providers remains to be seen, but I would consider this good news as of right now. All right, next, this is a very important sentence here. They basically did the table view down here. But shown below, the overall cloud market is expected to grow 21%, up from 19% in 2022, which we just covered. This will outpace overall IT spending with growth of 5.1% by over 5x. And it says 5x. I had a little trouble with that math because you would think 21% is not quite 5x of 5%. However, there's a inflation calculation involved, so I'm not going to nickel and dime that too much. Okay, now as a cautionary tale, you see this mixed reports following Q3 results. Gartner's prediction that cloud budgets will expand contrasts with other surveys that suggest the opposite. For example, according to a survey by Wayne Clouds, 81% of companies were directed by the C-suite to reduce cloud spending or to incur no additional costs. The venture capital firm Excel published a report that showed private funding for cloud companies dropped as much as 42% across Europe, Israel, and the United States in Q3. This often translates to lower valuations and/or lacking a clear path to a strong exit on the public markets or through an acquisition. So here she's saying the money flow from an investment standpoint into cloud companies has come down, and maybe that suggests that some of the highest dreams are coming down as well. But this doesn't mean the migration to the cloud is slowing down by any means. According to Excel, spending on automation and digital transformation is expected to rise from $1.8 trillion to $2.8 trillion by 2025. The drawback to these kinds of forecasts is that it may slow considerably in 23 before a rebound occurs. Finally, on the conclusion, cloud spending may turn out to be softer than industry surveys indicate, especially until inflation cools off. This is because surveys capture a perception while earnings results are the combination of a 7.1% inflation rate plus softer Chinese market and softer European market. The big three are the best proxy because their reports represent the layer in the tech stack that tends to be the most resilient in terms of churn. The switching costs are quite high for cloud infrastructure services. The big three can also afford a more concentrated view by owning 66% of market share across 3 companies, whereas SaaS is spread across thousands of companies. Okay, so what are my thoughts on this? Well, if we go back to the projections for 2023, I guess the first thing that comes to mind in this article as a whole is that there's no argument that the cloud and the different facets of cloud spending is going to go dark anytime soon. As a matter of fact, if you go by that last number on total spending, they were adding another $1 trillion to a $1.8 trillion market by 2025. All right, so to me, there's not a ton of argument that spending in this area will increase. Now, the X factor, I think in both sides of the coin, no matter which article you're looking at, is the fact that 2023 is a wild card. Right? We don't know. The first article mentioned the Fed and how, inflation and those things would affect spending. That was again called out in the second article, despite that article sharing a survey that insinuates that cloud spending will actually be up year over year, which to me is a good thing. So mixed messages, I would say, in my opinion, the data points, if we're going to use the survey, and we're going to go here in a second and look at some of the big mega cap cloud names, the data points are showing increased revenue, increased profits for the biggest of the big dogs. But it's the sentiment, what analysts feel about this market for 2023, that they're very cautiously suggesting hold. Wait and see where this thing goes. Now, considering everything we've seen in the stock market and the way stock picks have flamed out over the past couple years, it's probably safe to say hold. But I guess where I get a little confused is in the data points suggesting that things are still growing. So effectively, if you bought a Google or a Microsoft today at a reasonable valuation, then their revenue and their profits by the end of the year are going to be more than when you purchased it on a per share level, right? So that to me is a strong investment, or at least a solid investment. And then you start compounding in multiple years out to 2025 or so, then in a lot of ways, buying today could be one of the best decisions you make for the long term. Okay, I stacked up a couple of the big cloud names here on Seeking Alpha to do a stock comparison. I've got Oracle, Amazon, IBM, Microsoft, MongoDB, and Google. These were all the key components of the First Trust, that SKYY ETF that we have here, First Trust Cloud Computing. So I put those across the board. And again, we're going to think about this in terms of money. What is the outlook today in terms of revenue, EPS, etc.? All right, and taking into account projections, we'll look at PE gap forward for Oracle, 28. Amazon is not registering right now. I'm not sure where they're going to land. I know that their PE is running a little hot right now. IBM, forward PE of 113, so there must be something happening with IBM's EPS because just here over the last 12 months, their PE non-GAAP anyway was 1588, but their PE gap is showing a huge discrepancy of 113. Microsoft, 25 times. MongoDB, not 100% profitable yet. So they do not have one. Then you have Google, 18 times. All right, so across those, if you just want to say PE was everything and that's what you're going to compare, you're probably looking at Oracle Microsoft, and Google as those that are in what I would say is a reasonably fair valuation multiple. But let's check on the growth first, right? You do need to have some growth to support these concepts. So we'll go to revenue growth forward. Oracle, just under double digits, 9.84%. Amazon's at 13. IBM taking a step back, and that might explain the EPS discrepancy or the PE discrepancy, minus 6% for IBM projected. Microsoft, 13% growth. Mongo database, again, this one was not profitable, but 38% revenue growth in times like these. Even if you fall short of that by 20, call it 20% or so, you'd still be in the high 20s. Then you have Google, currently projected at 19%. Now let's take a look at EPS growth. Oracle, this is in percentage terms, obviously, 6% projected. Amazon, they're still getting their EPS sorted out, minus 8% right now, and costs have been killing them. It'll be interesting to see if they change some accounting buckets around, because they probably need to, in my opinion. IBM, 3% EPS growth. Microsoft, almost 12%. Mongo, not profitable yet. Google, 22% diluted EPS growth looking ahead. When you combine these, particularly Microsoft and Google, and you look at the top line of the revenue growth, you're still in double digits on both lines, okay? So Microsoft and Google, in my opinion, when you combine that with the cloud outlook, it's a pretty compelling story at today's prices for a longer term hold, and understanding that you're going to have some ups and downs in 2023. But when they do eventually take off, or when this economic sentiment does turn around, will you have the established position to reap the gains? All right, one more take from a bullish view. These are the top technology stocks as sorted by Seeking Alpha's quant rating. Okay, so that is their proprietary algorithm. This is what they're picking up in technology stocks. And what I want to do here, I mean, there's 600 of these, and you can see that I've got them sorted by quant formula. I'm just going to call out some of the cloud stocks that I see here in the first 100, because there was a handful of them. And I'm just going to scroll down here. We have Box, we have Allegro Microsystems, Arista Network, you have Nutanix, there's Yext, Workiva. These are all names that were in a couple of those ETFs we were looking at. Pure Storage, New Relic is tied closely to cloud. Snowflake, cloud security. And then scrolling down further into the 80s, we have Okta. And I think that's it in terms of the top 100. I'm sure there's other ones on here as well. So all of those names, at least right now from a quant score, are in 4s, which is green or potential buys from a Seeking Alpha standpoint. And usually with the quant score, they're going to get weighed a little more heavily over here, which is momentum and EPS revision. So if analysts are coming out and changing your EPS revenue projections to the upside, and or they see some influx of buyers, then that goes a long way in the quant formula, which is more or less of a short-term outlook. All right, so cloud stocks, in my opinion, right now, sentiment is very, very low. And I think that they are still lumped into the group, understandably, from 2022, where we saw the massive grind down in stock valuations. But at least from where my head goes, I think you have to choose wisely. I, of course, am just buying QQQ right now. I'm not buying individual stocks, but luckily, some of the best cloud providers are in the QQQ, so I feel really good about that. But as much as sentiment's down, and it could get worse, it is very hard to tell. I do think that from a cloud perspective, If you're willing to hold, maybe not even 3 to 5 years, we might be talking about 2 years at this point, then take a look at cloud stocks, do your research, look for companies that are profitable, look for companies that are growing the top line and the bottom line, and depending on your risk profile, it might be worth taking a crack at some of these names. Before you go, don't forget to check out that Seeking Alpha special offer in the description, $39 for the entire year to help guide you with some great stock market research and metrics you won't find anywhere else. I hope everybody's doing well. We'll see you on the next video.